We're joined from Hong Kong by Robin Bew. He's the chief economist at the Economist Intelligence Unit. So, Robin, thanks very much for joining us. Let's start out by talking about these PMI figures out of China this morning. This is a good indication of demand for Chinese goods elsewhere in the world. August was a particularly strong number. The question is this just a blip? Is the trend still showing a slowing economy in China?
Yeah, well, I think it's certainly an improvement from last month. It has picked up, so that's a good news story. Lots of analysts were worried that you were going to see the economy starting to slide even further downwards because of the measures that the government's taken. But I think we need to be careful about getting too excited about the positive number, because the policy measures that are being put in place are still going to slow the economy during the rest of this year. So as other interviewers that you talked to earlier on in the show mentioned, that the economy is slowing, the government's gradually reining back the amount of lending that's going through, and that's going to mean that growth will continue to decelerate.
So you expect that tightening from the government to continue, because some economists are even suggesting that perhaps as the rest of the world slows down, as austerity measures begin to bite in Europe, as the U.S. continues to slow, that China could actually switch to a looser stance.
Well, it clearly has that capability. The government's got a lot of money, so it could step back into the market, inject more liquidity and ask the banks to continue to lend. I think it's too early to say that we're at that stage yet. I think if you certainly saw America drop back into recession, so if we sort of double dip that people are worried about, then you would certainly see the Chinese government step in with more stimulus. But at the moment, that's a bit premature. We don't expect the US to drop into recession. As a result, we don't think China is going to have to step in and deliver more stimulus.
Right. Is that the biggest headwind for China right now, though? A slowdown perhaps in the US and in Europe?
Well, certainly China has exports a very important part of their economic growth story, and a weaker America and a weaker continental Europe as well, of course, is going to hold growth back. But that's something they're going to have to live with over the course of the next 5 or 10 years or so. The balance sheet adjustments that we're seeing happening in America and Europe are going to persist for a very long time. We're going to see consumers in America save a lot more, and that's going to continue for the next few years.
Right.
In Europe, you're going to see a relatively weak outlook, and as a result, China's got to get more domestic demand going.
Well, this is it. China has to stoke domestic demand, but you do have people's wages going up. We've just been talking about that, but at the same time, you also have the cost of living going up, the cost of everyday goods. So how does the Chinese government ensure that domestic demand keeps on increasing?
Well, one thing it's doing, of course, is allowing wages to rise much more rapidly than we've seen in the past. As you mentioned in the earlier piece, you've seen Foxconn, for example, has had to give some pretty substantial pay increases. You've seen strike action, which we haven't seen before. And while that's very nerve-wracking for Western businesses invested in China, this is actually part of a broader strategy to boost incomes and allow private demand within China to rise a bit more quickly going forward. So higher wages are an important part of the bigger story, which is that you need to see more domestic demand in China. And Western businesses, of course, do benefit from that. So while it's a worry for businesses to see their cost base rise very quickly, the end game, which is a more dynamic consumer base in China, is actually quite good for Western firms.
Okay, Robin Bew, chief economist and editorial director from the Economist Intelligence Unit. Thanks so much for joining us.